This is a potential breakdown setup for the US 10-year Treasury yield here on the daily interval. Each kind of representing the day. We have this primary downtrend line here, new key level right off the June reactionary highs with multiple reactionary highs to help validate that. And we have actually broke out of this primary downtrend line, and we are starting to fizzle out and potentially backtest this primary downtrend line. Now, if you're bullish on the 10-year Treasury yield going surging to the upside, that's exactly where you would want to start to short. Remember, it's inverse to stocks. You'd want to start to short those bonds right on a back test of that primary downtrend line right there, where yields will start to rise to the upside there. So we'll see what happens. Anything's possible. And really what had happened, we put in that divergent high. We had negative and or bearish divergences really constructed on all three indicators. Had a snap down breakdown off that primary uptrend line here off the March. Continuation lows there with multiple reactionary lows to put in the sell signal, broke down, had that back test of that primary uptrend line, and we never looked back, put in an advanced bearish continuation pattern. And that's where I'd mentioned in my previous video on a snap of this neckline, minor uptrend line here, would offer an objective short trade entry right at that 2928. In my previous video, we hit that first target, went on to hit that first target for a 6.5% drop, down to 262 for a 10.6% drop. And it carried on. It was good for an entire 14.2% crash there. And we actually had a bear trap, whipsaw reaction there. Came back out and broke out. Broke out amongst that primary uptrend line. And again, if you want to short the 10-year US Treasury yield, 2739 price support coinciding with this primary downtrend line. Now, big key level. That goes, that would be definitely a false breakout, momentum fueled overshoot, where you would have a potential back test of that primary downtrend line. And that's where I truly believe 262 price support will be taken out with conviction. And again, that's exactly where you want to see everything start to fail down there and undercut those previous lows, because usually the first big drop is followed by a much larger drop there. Not always, but usually right there at that 231 price support, if anything. So, and really that would be extremely bullish for the stock market. Equities would rise if we start to have a 231 price support. You know, a drop of that big in yields equals more fuel for the high growth tech stocks there. So we'll zoom in here on the 240-minute interval, each kind of representing 4 hours here on the 10-year US Treasury yield. And we've been putting a negative and bearish divergences starting to construct at least on just two indicators there on the MACD and oscillator. And we do have the 1033 stochastics there a little bit down below its 85 level. So anything's possible. But a snap of this primary uptrend line here, call it around that 282, 281. I truly believe we'll put in a sell signal on a solid candle 4-hour close below that. And here's some additional targets if it goes. Anything's possible. You know, we could stair step here, come back down here, and you know, anything's possible. We just start to burn out those negative divergences, and they get burned out. And the MACD and the oscillators divergence, negative and or bearish divergence get burned out, and rates start to just stair step higher. And that's when you start to have really some extreme pressure on the stock market, in my opinion. So we'll see what happens. Keep you updated if I see more significance on the charts.